Hello, everyone. This is Farid from ASCO Shipping Company. We're pleased to have now today our H1 discussion session for the results of the first half of 2025. The presenters will be our CEO, Dr. Ibrahim Al-Nodiri, our CCO, Mr. Imad Al-Khoury, and our SVP Finance, Mr. Ahmed Al-Shakiri. We will have today, the first slide will just be a quick disclaimer about that the purpose of this session is to provide an overview of ASCO Shipping. The presentation is prepared for the use of for public and non-public information, and the presentation has only been prepared by the company. It has some forward-looking statements, so we urge the public not to use this as advice. And the presentation also includes non-IFRS measures. So we will start with Dr. Ibrahim, who will take us through the first slide.
Well, good day to everyone. I'm joining the meeting here from Korea today with my team from in Oman. Basically, again, welcome to this session of performance, basically of ASCO Shipping Company performance and audited results for H1 2025. So this year so far has been full of opportunities as well as challenges, of course, which is going through the entire industry. However, we have a very positive outcome, and for this, the last 6 months, we've basically had a very stable performance amid volatile market. Of course, there are a lot of conditions driven by the microeconomics and geopolitical factors that I believe that all of you are aware of. Despite this, ASCO Shipping Company has done great. We've achieved a gross revenue of over 164 million Oman Riyal and time charter equivalent revenue of over 142 million Oman Riyal. That, of course, showed in our solid adjusted EBITDA margin of 68% so far. We have also continued on our growth story and growth strategy as promised, with almost 98 million Oman Riyals, that is equivalent to over $250 million in investment into our fleet acquisition, and that is mainly to acquire new ships and to renew our fleet. We've done also strong in terms of continuation of our focus on asset optimization. We've pursued a leasing strategy focused also on time charter, hire contracts, as well as securing favorable terms. We've signed 10 new long-term lease agreements in H1 2025. That, of course, wouldn't have been achieved without maintaining a vigilant eye on our ESG and our safety culture. This is, as we have always been talking about, our safety comes first, and this is basically achieved by having 0 lost time injury frequency achieved over the last first 6 months of the year. And we've also recently announced dividend of 556 paisa per share for H1 2025 to be paid in September, the coming September 2025. And this is, of course, in line with the stated dividend policy, the same thing that was promised in the past, and it represents an annualized dividend yield of about 9% to date. This is in summary of our key highlights and key achievements over the last 6 months of first 6 months of 2025. I will maybe ask my colleague Ahmed to take you through the financials.
Hi everyone, I'll take you through the first half financial performance. If you can go to the next slide, please. As mentioned by Dr. Ibrahim, the first half this year was really tough half compared to last year. Despite that, ASCO Shipping, due to their right strategy of diversified portfolio and also secured a lot of long-term contract, and it is already there in our backlog. And also, when we saw the market is really not stable. So we have managed to do a lot of good decision during the first half, which end up ensuring that we have a stable financial results for the first half. 164, almost 165 million gross revenue. Almost 87% of that was time charter equivalent revenue, 142.7. That means that we have secured those ships in with other operators. So we charter our ships out. Then we managed to achieve adjusted EBITDA from the revenue TCE revenue calculation of 96.7 million, and that reached to 68% EBITDA margin, which is still very competitive compared to the industry as well to other companies. And from gross revenue level point of view, it is 59% EBITDA margin, not the adjusted one. That end to be net profit of almost 20 million Oman Riyal, which is in this market and the tough situation we have been through this half, consider very strong achievements, and still the result is we see it as very good results. As mentioned by Dr. Ibrahim, we are maintaining our dividends policy for the first half to pay 5.56 paisa per share, which will be done in September this year. We will have the OGM by 10th September, inshallah, already announced. That will be done also virtually, which approved also by FSA. The net debt and the balance sheet was also see a very solid and healthy positions. So our net debt stand at 381 million Oman Riyal, which calculated, of course, as you know, from mainly this is focused on the long and short-term loans minus our cash and cash equivalent, including the deposits in the bank. The net debt to EBITDA remain at 1.8 times, which is considered as healthy and comfortable position for us for future growth and to invest further on the company. We maintain our growth story as planned before. So we have spent almost 98 million Oman Riyal in the first half, and there is almost the additional committed of 65 million Oman Riyal to be paid in the second half as well. While maintaining the cost discipline and targeted better revenue for the second half, we focused a lot on our operational excellence, and we managed to have a zero number of accidents and lost time frequency, as well as zero number of ship detention during the first half. Moving to the next slide. Here, to compare the last year half to this year, 2025, the first half. Of course, last year was stronger in terms of the gross revenue, and declined by 9%, equivalent to almost 16 million Oman Riyal. However, due to our cost discipline and also focus on every single items, we managed to reduce that and offset some of this reduction in the revenue and the gross profit level to reach to 11 million. So almost 5 million was offset in the gross profit level. And of course, we continue the same discipline in the cost, and also as much as we can do during the first half, and offset it almost another 5 million to reaching to 7 million difference between last year and this year. So net profit was 20.2 compared to 27.671. Of course, we have reduced our debt due to a lot of loan repayments and also utilization of existing cash instead of getting additional loans to pay the new assets. So that's improve our net finance cost. We change also some of the strategy in terms of the voyage operating cost. So we go more in the stable TC level compared to the voyage level, which was not stable due to many issues during the first half, like the tariff, like also the decline in the economy because of the new administration in US, because the people wants to see the stability and many other reasons. So we focus more on the TC during the first half. That's reduced our voyage operating cost by almost 22%. Also, chartering hire expense we have reduced by 4% to ensure we get only the right TC price for our operation, because we saw there will be maybe further decline in the first half. So we didn't fix a lot of ships from the market until we analyze the right ship, of course, to be added to our fleet. That's left the company fell by 27% versus last year. But we believe this will be in a better position for the second half this year. Going to the next slide, we'll go by segment wise here and show the utilization and also the revenue and profit in each segment maintained. Gas segments was achieving a 54.7 time charter rate for the all LNGs we are having. Of course, there are some rates, a very good rate, and some vessels were not a very good rate due to the market. So you can see the utilization in LNGs was reduced to during the first half to 86%. This mainly due to the heavy drop in the gas segments, due to a lot of vessels were delivered, which supposed to be linked to a specific project in the LNGs worldwide, but those projects were not ready. So accordingly, they compete with the existing ships in the market, and one of them, one of our ship, which was also operating in the spot market, and that was tough for that ship, which we didn't charter it for almost 3 to 4 months during the first half, and that's why you see the utilization rate dropped for the gas segments. We believe that the second half we already chartered this ship, so we'll improve that utilization rate for the second half. The revenue reached to 24 million almost the first half compared to 25.7, and the net profit reduced from 13.1 to 9.9 in the second half, and we are taking all the cost measure required and controlling the cost in this segment to make sure that the profit is improved for the second half in this segment. In the crude segments, it was done well in terms of the utilization as well as in terms of revenue. We added more ships to the fleet by chartering from the market. So the revenue was increased to 49.3 compared to 48 last year. But because those ships came in the middle of the first half, then there will increase in the higher ROE depreciation. It was not offset by the increase in the revenue. But we believe the market will be in a better shape for the second half, and we will improve the net profit from its current position. So 8.4 million net profit achieved from this segment compared to 10.2 last year. The product segments was the most, I think, difficult segment during this year due to the market huge change in this segment. We managed to full utilization almost of this in this segments. However, the market rate dropped from almost 28,000 last year to 23,000 per day this year in the MR segment, the vessels we are chartering from the market. And that's accordingly the revenue dropped from 47.7 to 41.9. We are doing a lot of efforts in this segment, chartering more ships just to reduce the impact on this segment, and also getting it in this current market, which is lower than what we have done last year. So that will reduce our reduction in this segment. So 2.3 million achieved with this difficult situation in the segment. We still make a good profit compared to 4.7 million last year. Again, similarly, the tribal was also facing a difficult market due to the economy turnaround in the first half, and China slowed down their production due to a lot of issues, specifically the tariff from US. So they were a drop in the TC to 12.5 compared to almost more than 15,000 last year. And that's, of course, make the revenue dropping from 31.3 to 25.3. And the net profit as well dropped from 11 to 7.6 million. We believe the second half, again, for this segment will be much better than first half. We have secured almost all of the existing fleet in a better rate than the first half. The liner was one of the best performer due to the management decision to change some of the strategy and operating in this segment. We noticed there is potential opportunities by chartering out our ships instead of operating them in the reduced and freight rate. So we managed to get very good charter out rate for our ships, which turn around the whole segments, and from a loss of 3.2 million last year to a profit of 1.6 million this year. So that was really a good change, and we believe this will be even better for the second half of this year. Moving to the next slide. From balance sheet point of view, as we can see in the chart, we have improved our total assets mainly due to the expansion and the growth in the buying ships, as we have announced also on the prospectus last year, and as well on the website and MS6 platform, that we have purchased second-hand VLCC during the first half, as well the existing committed ships, that 2 LNGs and the 4 VLCCs and the 2 MRs already committed since last year. So that's maintained the growth in the assets by almost 9%. The total equity reduced by 3%, of course, mainly due to the dividends we have paid during this year to all the shareholder in March for the first half, and the profit was not enough to offset those this dividends paid during the first half. Of course, we believe that the second half will be in a better shape, but we will also pay another 29 million in September, Oman Riyal, and in September for all the shareholders. The total liability increased by 18%. Of course, this is mainly to recognize our additional ships as a right of use assets. 10 vessels were added to the fleet and renew some of the other assets during the first half. So this, of course, will record liability, and because we have to, due to IFRS, you have to record all of this in the liability side as well as in the asset side. But those assets are in a very good rate, and they will add a lot of value to the performance of the company, specifically in the dry bulk and in the product segments. The new financing also obtained in the liability side, and that's why we can see the increase in the total liability. We have get a new loan for our acquisition, to pay our acquisition for the VLCC, specifically this second-hand ships. The rate we have achieved this loan a very competitive rate, and it will help also funding the vessels. We believe these vessels, one of them already delivered in July, and it start also generating revenue and EBITDA for the company in a very good rate. As well, also the second one will start in August. We already received the vessels. We are doing the dry dock for the ship. It will start also in September, adding a lot of value to the VLCC segment, which will also improve the results for the second half. The leverage position, a very comfortable and stable position. So we maintain net debt to EBITDA to 1.8 times, despite the new financing for the acquisition of the VLCC. You can see also the return on assets is even better than last year. Last year, the first half or the full year, it was 2.8%, improved to 4%. And the return on equity remain on the same level, almost 10% compared to 11% last year. Debt to equity ratio is still okay, and it's 1.1 times level. Now I'll hand over to Mr. Ahmad, our Chief Commercial Officer, also to explain the commercial side.
Yeah, thanks, Ahmed. So looking at the portfolio of the company here, what we have is 94 ships in all the different segments that we have, divided between owned ships, leased, and the committed ships that will be coming and joining our fleet. The average age is about 9.5 years in terms of the ships that we operate between owned and leased. So starting off in the gas side, on the LNG ships, what we see is that we have 2 ships that will be joining us in 2026, which have a long-term charter attached to it with Oman LNG. Currently, our owned ships in the gas segment is 7, plus 1 ship that we have taken from the market for the local business. On the crude side, what we have is 12 ships owned by Asiyat Shipping Company. This is the result of us selling the older ships and going for 6 ships in 2025, where we've taken 2, and 4 coming in 2026, with 4 crude carriers on the Suezmax side, which we have taken in from the market. On the tanker side, primarily on the Amar segment, which is the medium-range tankers, we have 15 owned ships. We have taken 23 ships from the market, where we operate on the west market and also on the east side, capitalizing from 2 different markets in terms of clean petroleum products. 2 ships we have contracted for and will be joining us in 2026. This will be mainly for our methanol trade between Oman and the West, chartered out to OQ. On the dry bulk side, what we have is 11 owned ships. We have leased 6 from the market. In this segment over here, with the strength of the VLOC segment, it gives us good room to leverage with chartering in ships from the market. And also on our Ultramax and Kamsarmax segments, what we do is that we do some regional trade, carrying different commodities from the Arabian Gulf to Asia, and also bringing in bauxite from Australia to Oman. So the trade within the dry bulk segment varies depending on the commodity we're carrying and the different charters that we're working with. On the liner side, given the strong increase in the charter market, we managed to charter out the ships that we have between owned and leased, which gave us a good edge, as explained by Ahmed. In terms of moving on the container operation side, we followed a NVOCC model in order to capitalize on the containers that we have. However, in the upcoming months, we will be going back to operating a chartered in ship and moving containers within our own fleet, as the 3 ships that we have will be coming out of service, and we will be chartering in more ships with the right price. As you can see in the bar chart indicated over here, the movement between Q4 2024 and Q2 2025, the movement between 86 ships between owned and leased and committed to 94. So this is primarily driven by the tanker side, VLCCs, product tankers, and also in terms of the LNG ships that will be coming and joining us by 2026. Next slide. So looking at the market, this is a quick snapshot of the market and all the different segments. On the gas side, what we can see is that during the first half of 2025, the rates were under a lot of pressure. We had exposure with one ship in the market idling for some time, but then we managed to get a charter for it. In terms of our other ships, they're committed towards the end of the year. The market dynamics over here is something that we are witnessing, whereby you have a lot of ships coming into the market and the projects, the LNG projects, not catching up to speed. Thereby, the demand, supply and demand of ships to LNG projects is having a mismatch, driving the rates down. On the crude side, we see a very positive market sentiment and growing within this period. We see a very strong 2025, especially in Q3 and Q4, mainly driven by the increase of OPEC production and also a strong Chinese demand and the supply and demand aspect of VLCCs versus the number of barrels to be transported is a bit of a mismatch, therefore driving the rates up on the crude side. On the product side, what we see is that the market currently is softening, and we expect it to soften even more in 2026, especially with an increase of more MRs coming into the market. And this is where we have made some adjustments in terms of the number of ships that we will be taking from the market. So we're waiting for the market to cool down, and then we will be taking some ships. The ships that are currently within our portfolio will be or started to actually leave us during this period from now to 2026. Therefore, there's some adjustment going on here in the product side. Again, it's the projected supply of ships coming into the segment that will cause a bit of a disturbance. On the dry bulk side, what we see is that the market was a bit soft in terms of the first part of 2025. We see that the market currently is recovering. One of the main attributes is that the rerouting from the Red Sea and also the pickup of demand from the Chinese market coming up as expected towards the end of the year. On the liner side, what we see that the sizes of ships that we mainly operate or have interest in was quite strong during 2025. We see, however, on the container rates, the freight rates softening in the current market. We had a good hedge this year and also hopefully towards 2026, where we've chartered out the ships within our portfolio, and we've chartered in cheaper ships in order to continue our operations of transporting containers within the different countries that our route passes by, especially from China to India and then into the Arabian Gulf and then into the Red Sea. So this gave us or will be giving us good rates in the coming future. However, the risk is always prevalent in terms of the US trade policies from China or from different countries. So that exposure is always there, and it's inherent in the liner business. Okay, so to conclude, I pass it on to our CEO, Dr. Ibrahim.
Thank you, Ahmad. So just to continue what the team was just saying, for us, how we see ASCO is basically that we have also a robust backlog of $1.7 billion dollars contracted revenues, and this goes throughout the 5 segments that we operate, whether in the gas or the crude, the tankers, in products, as well as in the dry bulk and the containers. So we see this is coming up nicely. We will, of course, you could also tell from, despite the key financial highlights, we still maintain a positive view, considering considering the strong, I would say, the strong commercial and technical management that we have in-house. And therefore, we will continue going with a solid and predictable financial profile. 68% of adjusted EBITDA is very competitive, and we will continue having these margins, such very positive margins, throughout. Our net debt to EBITDA ratio is just only 1.8 times as of end of June this year. The cost of financing for the last 12 months was maintained at 5%. This is, again, it shows also the financial strength of the company, and we are receiving good offers every now and then to basically finance our projects. We have, as I said in the very beginning, that we have a clear growth strategy, and we will develop in priority segments, as also mentioned by the team in Muscat, that our expansion plan, which is between $2.3 to $2.7 billion between now and 2029, will continue there. We will be looking, of course, maybe if we can enhance that. However, the last 6 months also proved that spending a good amount of money, which is over $250 million, basically to acquire new ships, in terms of spending that on capex as of H1 2025, also shows that we have a strong plan to continue our growth strategy. The dynamic leasing strategy to deliver shareholders value, well, of course, is one of our top priorities, which we will continue to follow. Saying that, I would conclude by saying that the shipping industry will continue to be exposed to some pressure, mainly due to the macro and geopolitical difficulties that been faced by the industry. Yet our results show a robust performance that we could actually ride the high seas, and we will continue optimizing our fleet, and the management is very confident that we will enhance our performance over the second half of 2025. With that being said, I think we conclude our presentation, and we're open to the questions from your side. Thank you.
Thank you, Dr. Ibrahim, Imad, and Ahmed. Whoever would like to ask a question, please, if you could raise your hands. Or you can use the chat, but I can see now Boris would like to ask a question. Yes, Boris, can you go ahead?
افتح لي الميوت maybe.
Yes.
Once again, sorry.
Yes.
Hello,
Yeah.
can you hear me?
Yeah, we can hear you.
Okay. Thank you so much. Thank you for presentation. It's Boris Sinitsyn from Oman Investment Bank. I have a few questions. Maybe I'll just ask them one by one if we have time. The first one, could you please elaborate a bit more on the second half of 2025 revenue outlook? It looks like you added ships throughout the first half, one factor, and the other factor being basically some additional supply in some of the markets, namely crude oil. I'm talking about increased production and exports from OPEC plus countries. So if you provide my broad outlook on the revenue dynamics in second half versus first half by segment, would be really helpful.
Yes, as mentioned in the presentation, we believe that the second half will be better than first half, because the whole economy is improving actually, and those factors which was there, like the tariffs, the slowdown in China was not as hard as that time. And we also, from our side, we are delivering more ships to the fleet. So the 2 VLCC is coming in July and August. So that will enhance our performance. We have secured already a lot of good rates in the end of second half, and also July and August. Already done some good also secured of good TC, specifically in the dry bulk as well as in the container business VLCC segments. We have charter also ships in the product segments where we in the current market, which is low, and we make a good margin on those ships. So that's why we are confident that the second half will be in a much better shape than the first half. Even the one of the LNGs, which was not chartered for the last 4 months, it will already start charter now and in the second half. So that will enhance also its performance. Saying that, of course, we are also taking all the requirement of the cost discipline in terms of the reduction in our interest rate, and in terms of also the control we have both the administration cost as well as also the operating expenses, specifically in the old ships. So that's why we are confident on the performance on the second half, and we believe it will be in a better shape than the first half. Yeah, the 2 VLCC already.
Thank you for this. That's clear. Thank you again. Second question, please. When thinking about capital allocation in terms of your capex plans for fleet expansion next year and coming years, in terms of dividend payments, what is the comfort leverage, financial leverage level in management's view? What is the metrics which you are looking at, and what is the level, I mean, the value above which you would try to be more cautious in terms of capital allocation?
Yes, I think we are in a very comfortable position in terms of the leverage today. We have, maybe if you notice that we have also done RFP to finance our existing committed ships, the new LNG, the VLCC, and the tankers. We have received more than 2 times offers from the bank to finance those ships. We are analyzing those offers, and very competitive rate we have managed to achieve. We can finance those ships if we wish to 100%. We are considering, of course, not to go that much, but we have those offer on the table, which will ensure that enough financing is available for all the new ships. And we are also considering some of the new loans to refinance some of the expensive debt already in place. So we believe from financing point of view, from the leverage point of view, we are in a comfortable position today, and that of course will enhance our capabilities to continue the payout for the dividends, and we don't see any impact on our targets in this.
Okay, that's clear. Thank you. And the last question from my side, please. I think during IPO you had plans of vessels sale in 2026. I think in 2027. Do you still like keep these plans to sell the ships intact?
Yes, the plan is still there to sell the ships as part of our renewal strategy, and also it supports us in terms of our growth going for more modern ships. So this will hopefully be coming up in the foreseeable future, especially when we see that the right time to sell the ships and get a good capital gain from the sale. We will definitely execute on that. We're constantly monitoring the market for that.
Thanks. Just follow up on this, just for my better understanding. Is it a rather opportunistic sale, or you still think that anyway some number of ships to be sold as planned next year, for example?
It's as scheduled, simply because we want to have a modern fleet, so we don't want to keep the older fleet within our portfolio. So it's in schedule, but we just want to get the right timing, especially at the beginning of the year. You had a lot of market destruction and the sentiment wasn't there. Now we see the sentiment building up, and therefore it's something that we would see ourselves capitalizing on.
Just to also add to what Matt mentioned, and I think you're right. So we always analyze of course, we choose the right time, but we do the analysis if the vessels, even if it is old, it will add more value for the shareholder and also our profitability, keeping it or selling it. So whichever is the best outcome, cautiously, we will do that.
Thank you. That was my question. Thank you so much.
Thank you, Boris. Anyone else would like to ask any questions, to raise their hands, please? Hey, Rahul, I will allow your mic. Should be able to unmute from your end.
Thanks, Farida. Thanks to the team for today's presentation. Just maybe a follow-up on what you've said and what Boris was asking, but you've given some comments around H2 versus H1, but could you perhaps also comment on full year 25 versus full year 24, and whether you see any changes in the guidance that you've previously given? Thank you.
Yeah, I think we remain better than we believe that will be, if not better than 24. It will be in that range. Seeing the confidence on the second half for this year, we are taking all the measures and all the everyone is the management is putting a lot of focus on improving the results for the company, and market is also supporting. Market is improved compared to the first half. From guidance point of view, I think that's still in line, slightly lower, but not in a worry and alarming situation, let's say.
Thank you very much.
Thank you, Rahul. I will now allow Heba. Please try to unmute yourself. Heba, if you could unmute from your end. I'm not sure if anyone wants to ask. Anybody else would like to raise their hand?
I think maybe for Heba, she is unable to unmute. Can you help her from your side?
Yes, it is unmuted from my end. She has to unmute from her end. It's allowed, the mic.
Okay.
Maybe if you can write your question in the chat. Or if anyone else has any other question at this time. Okay, Heba's asking, how did the spot market react? How did the spot market react after the regional tension in Q2?
So we had on the spot market, we had a bit of a spike on the spot market after the regional issues, and then the market softened very quickly. And now we see the spot market coming up, primarily driven by the supply and demand of crude vessels in the market. That's the main spike that we had during this period.
Okay, thank you, Ahmad. Does anyone else have any other questions? Okay, Mohammed, I will allow your mic.
Hi, thank you so much for giving me the opportunity, and congratulations on a good set of results as well, despite the turbulence. Okay, just wanted to add upon this question of the Q2 turbulence. So just thinking around this line, so you said the market did spike for a bit. So during that spike, what was the delta, for instance? I mean, the fuel cost also went up, the bunker cost. So on a net basis, so for instance, the tensions were there for 8 or 10 days. So was it a profitable moment for Asyad, or on a net basis, it wasn't a profitable thing, although the market did spike, but what was the impact of bunker costs, fuel costs?
Now, on that, well, look, with that regard, with that increase was very short, especially with the U.S. administration announcing that everything is neutralized. So the cost did go up, but it was very short-lived. Let me put it that way. So from our side, we had our ships already contracted. So that window of fixing ships was not something that had impacted us either negatively or positively. We continued our earnings as we have contracted in a positive manner, and we just made sure that we move on, and then that future, let's say, increase in the spot market had a good effect on the TC market, whereby when we TC'd our ships out, we also TC'd them for a few months on a good rate. So overall, there was a good positive impact on Asyad shipping with that regard.
Okay. Just again, one more thing. Assuming the similar situation happens for, say, a bit longer, say 2 months or so, would that be a net positive for Asyad if everything else remains the same, just the timeline extends?
Yeah, if that remains the same, then we could see some positivity, especially on the tanker side, because the tanker rates would be going up. Of course, fuel prices would be going up, but then every owner would put their own or an increased buffer into their charter rates, which eventually would increase the market. So yes, with these tensions and these political changes that happen, usually this impacts shipping in a positive way.
Okay, thank you so much.
Please go ahead.
Can you hear me?
Yes, we
Yes,
can hear you
Abbas.
now.
Thank you. Just could you give us a little more color on how charter rates are behaving after the quarter ended? Because we saw YOY, when I compare your YOY numbers of 25 to 24, of course, there's a massive drop on the revenue and on the profitability side. And you did go through the presentation and you were highlighting how the second half is going to be better. But just to appreciate, other than the new delivery of the 2 ships that is expected to sort of come on stream, what else are the factors that you're looking at when it comes to charter rates and how they expect it to behave for the remainder of the year? I'm not sure if you answered this, but I kind of missed it in the conversation.
So basically, your question, just to understand, is basically what you're asking, how the dynamics of the charter market behave? Is that what you're asking?
Yeah. What I'm saying is, when you look at the first half and what you saw, And of course, when you compare that to 1H24, there was a drop. I mean, that's what's sort of evident in your numbers. I'm trying to understand what's happening in the second. We're already in the second month of the third quarter. I'm just trying to see what has changed on the ground. If charter rates have firmed up, what do you expect for the remainder of the year, and let's say an early sort of peak into 26?
Okay, so if I just focus mainly on the crude segment, which is the most volatile segment moving with regards to any political aspects, especially in this region, what we see is that we see a firm up in crude prices, mainly for the factors that you have less number of VLCCs in particular compared to the demand, because oil majors or oil traders would like to carry crude on long hauls. So that the demand of the ships themselves is an aspect. The second aspect is that there is more being produced and more crude in the market coming up compared to the number of ships. So especially modern ships. So these are the two variables. Increased in oil and less number of ships is what is driving the prices up, especially in this period.
If I may add also and put some color on from numbers point of view. For example, the VLCC last year was in range of 30, 40 plus in similar quarter. This year, the first half, it was the spot rate dropped to a level of 20s. And now the second half, it is again back to the 40s. So that's how we see the impact on the TC rates. For example, the MRs, it was in range of 28 last year, sometimes even reached to 32,000, 36,000 per day. Dropped to a level of 16 and 17,000 in the first half. Now it is in range of 20 to 22 and 23,000 sometimes in the second half. So that's fluctuation, and those rates, of course, add some value for vessels who is open and they can benefit from the market.
Yeah, that's helpful. What percentage of your revenue comes from the spot market versus long-term charters?
Yeah, of course. I think most of our revenues secured now but there is still remain some percentage, like 10 to 15% remain to the market fluctuation. That's still, and of course we keep adding from the market when we see there is a potential growth and opportunities in the market. So we charter from the market and we operate them again on the market. So, but as the visibility of the second half, almost 15%, not more than that, to the market still open.
So if you were to prescribe two major reasons for this YOY drop, the one that I see in 1H25 compared to 1H24, would you say it was largely coming in from the spot market? Because it seems your utilization levels were okay. Maybe in the crude side, I think the utilization dipped below 90. But on the other segments, LNG, forgive me, yes.
Yeah, I think it's mainly, as we said, because spot, not necessarily voyage. Spot is the rates itself in terms of voyage and in terms of the time charter was in last year was in a better shape than this year, specifically the first half. Of course, whatever we secured last year, we cannot get the same rates in the first half this year. Like one of the LNGs, it was in range of 41,000 last year. It was secured, and that this year it has very competitive market. There is a lot of idle ships also in the market, so hardly you can get any charter for the first half. Similarly, the tankers was easy to fix in 28, 30,000, and the market wholly dropped to not to that level, to less than 20 even in the first half. So if you have any vessel open, of course it will get the market rate. You cannot get more than the market rate unless you fix it earlier than the drop.
Okay. And as we speak, only 15% is on the spot market. Everything else is on a sort of committed contract.
This is today for the remaining of the
Correct.
of the second half. Yes.
Clear. Thank you. Thank you very much. Good luck, and look forward to interacting with you again.
Thank you very much, Abbas.
Thank you.
I think we have time for one more question if anyone has. Otherwise, we'll conclude today's session. I think nobody else has any more questions.
Maybe if Ibrahim wants to
The
close.
CEO wants to close the call. Thank you very much.
We appreciate also, maybe to add, Dr. Ibrahim, we appreciate the confidence of the shareholders, investors and it was seen also in the asset, the share price, and it remained a very good price for the last period. Maybe if you want to add anything, Dr. Ibrahim.
Oh, thank you very much, everyone, and for joining us today. It's been a fruitful session. As you could see, despite all the challenges, we maintain a very good story, and the team is very confident that we're going to move to a different era for the second half of this year. We are also very much grateful for the shareholders for showing their confidence in the company. Today's share price shows a very good performance. It's a very good progress. Our initial, I think, share price when it was listed was 123. They were talking about 130, 132 basic. Despite all the challenges, that we are making a very good progress. So once again, thank you to everyone. Thank you for joining us, and we look forward to seeing you in the future sessions. Thank you.
Thank you.
Thank you.
So-